Now, according to Bankole Odusanya, a fixed income trader at UBA, activities in Nigeria's treasury bills and bond markets this week have been largely driven by foreign portfolio investor sales and asset switching by pension fund administrators. He joins us now for fixed income and FX update. Thank you, Bankole, for taking the time out to join us.
Thank you, Esther.
Well, tell us about this, trading activities being driven by FPI investors and the sale and asset switches that we've seen at the market. Give us a better understanding of that.
Okay, Esther, the financial system has been very liquid, and usually when the market is liquid, we see a bullish trend, especially in the treasury bills market. There's been an unusual trend. We've seen a lot of sales this time around. As of Monday, that's Friday close of business, system liquidity was up to about 800 billion. We expected the bullish pressure, but that didn't happen. We noticed that there was sales of certain maturities in treasury bills, especially on the July maturities, 19 July to be specific. And we noticed there was some more interest, demand pressure on 2027 bonds, because that's the highest yielding, highest bond by way of coupons, which is about 16.2%. We noticed that they were selling on short-term maturities and buying some long-term maturities, not just FPIs, but PFAs who are switching, making certain switches to their portfolio, given the new allowance they have to have 4 classes of investment.
So I want to switch over to the Forex market a bit. Has the pressure on the Naira abated, or is it likely that there's going to be more pressure a little down the road?
Yeah, it's not freeway yet. Right now, what we're seeing is that the pressure that we saw in the last 6 weeks on the INE market has abated actually. The central bank stepped up its intervention by way of selling more to banks and to retail customers and ensuring that such sales were made. On the INE market, the supply has increased, and I do not think that the demand has waned. I mean, because we're going into mid-year and approaching H2. And of course, it's summer vacation period, and very soon, by September, schools will be resuming. So I want to believe the demand is still there, but the central bank upped the game. And because confidence was shown in the market, confidence was returned to the market, I believe the surplus unit who had dollars also has quickly took advantage and sold before rates got back to where we are today. Rates is at 361.20, and as at 4 weeks ago, it almost got to 363 levels. So the pressure has abated for now, but that doesn't mean it's a freeway. Going into the year, when there will be more FPI activities, we expect that there will be some more pressure, not just by way of sales of securities and purchase of dollars, but by reduced inflow, capital inflows into the country in H2, as predicted.
Now, Bankole, equities traders and analysts have told us that there's been a flight to safety from the equities markets, investors piling cash into safe government securities such as fixed income. But I spoke to a fixed income trader earlier today, and he said that that wasn't the case. What are your thoughts?
I didn't get the question clearly.
I spoke earlier this morning we've been speaking to equities analysts who've told us that there's been a flight to safety from the equities markets to the fixed income markets, of course, to hedge against risk at the equities markets. But speaking to a fixed income dealer this morning, he told me that he didn't think that that was the case, that he hasn't seen that demand coming from, or that switch coming from the equities markets. Is that what you've seen too? Are those your sentiments? Okay.
If I was to speak to the activities of FPIs in the equities market, it's not just influenced by what's happening locally. That is by way of liquidities or decline in prices at that market. It's also influenced by what's going on in the U.S., the strengthening of the dollar and the currencies markets, and then the trade wars and threat of trade wars. Yesterday, the U.S. actually came out to say that its withdrawal of the deal with Iran must also cover its allies. That is, its allies who continue to trade with Iran may be sanctioned. That in itself caused a jump up in the crude oil prices, and we expect some more strength to the dollar for now. And it's a topsy-turvy, depending on the response we get from China and other European countries. But for now, this volatility is not in favor of the emerging markets, as we've seen some FPIs simply sell down on their securities and fly to safety. It's a line to watch in safety is gold. There's probability that gold prices will rise and dollar value will continue to strengthen against other major third currencies. Thank you.
So with all this, with all these developments in international markets, what do you think the July MPC meeting will bring? Just very quickly, we have under a minute.
A major factor to be debated by the members of the MPC will be inflation, which is now at 11.61. It's dropped for 16 times. I think at the end of the day, and as usual, rates and major monetary policy stance will be maintained rather than change, because the central bank, in their posture, want to keep stability, not just rocking the boat, especially going into an election year where a lot of funds are expected to be spent as budgeted and appropriated for in the 2018 budget. And the Ministry of Finance has confirmed they will be borrowing more locally to fund this, the deficit. So that's a lot of topsy-turvy ahead in the year. I would expect that the central bank and the MPC will make all attempts to keep everything stable, all the monetary policy stance.